Greetings, my name is Mr. Simbi and welcome to today's accounting class. In today's class, we're going to be talking trading stock surplus and trading stock deficit. Did you know that a business can use either the perpetual or periodic inventory system for managing or controlling its trading stock? Here are today's lesson objectives. Firstly, we are going to calculate and adjust for trading stock deficit or surplus. We'll also calculate and adjust for consumable stores on hand, that is stationery and packing materials. Here is what you already know by now. You already know to post from the cash and credit journals to the general ledger. You also know how to prepare the trading stock account as well as how to do the accounting equation. These are the new words that you will learn in today's class. Perpetual inventory system. What is this perpetual inventory system? This is an inventory system that keeps an ongoing or continuous record of all stock items that are purchased and sold. We'll now look at the definition. We'll start with trading stock surplus. What is trading stock surplus? This is when the physical stock count is more than the book stock balance. So it is very important to note that when we're dealing with trading stock, we will have to do what we call a physical stock count. This is when we individually count all the stock items that the company has in the business. Then we compare what we would have found on the physical stock count against what is in the books of the business. And then when the physical stock count is more than what is in the business books balance, therefore we will have what we call trading stock surplus. We will also have what is called trading stock deficit. Now, when the physical stock count is less than the books stock balance, then we have a trading stock deficit. So remember the difference between the two. With a deficit, the physical stock count has to be less than the books stock balance. So the books are saying we have more, but the physical stock is saying we have less. Then we have a trading stock deficit. But with a surplus, it is when the physical stock count is more than what the books balance is. We have already defined trading stock surplus when we said this is when the physical stock count is more. The physical stock count is more than the stock balance in the books. The trading stock account in the general ledger indicates the value of trading stock that should be available for selling. A physical stock count is done at the end of the financial year to determine the value of stock that is in the business. Now, in our business books, we have stock to the value of 12,000. This is according to our business books. Then we did a physical stock count. Then we counted all items in the business and we found stock to the value of 14,500. As you can see here, there's a difference between the business books and the physical stock count. Now, the fact that our physical stock count is more, that therefore means we are going to have a trading stock surplus, and the surplus is 2,500. How do you get the 2,500? We say 14,500 minus the 12,000. That is how you get your trading stock surplus. It is a surplus because our physical stock count is more than the amount in the business books. What are the reasons for us to have a trading stock surplus? The first one, it is when errors are made during the year, such as incorrect markups. So the first reason is going to be because of errors. The second reason, it is also errors that would have taken place when we do our stock taking, errors in stock taking. The third one is omissions of stock purchases in the trading stock account. That is, when we buy stock, there are omissions that would have taken place when we are recording in the trading stock account. With us here, we have an activity and we want to see what we are going to calculate. Are we going to get a trading stock surplus or a trading stock deficit? And it reads, extracted from the pre-adjustment trial balance on 28 February. And we have trading stock. So this is trading stock in the pre-adjustment trial balance. In other words, this is trading stock according to the business records. This is trading stock according to the business records, and it is 63,800. There is an adjustment, and it reads, a credit note received from creditor B. Baloyi for goods returned 700 has not yet been entered. So the moment you hear a credit note, it simply means goods have been returned. It's a credit note received from a creditor B. Baloyi for goods returned. Has not been entered. The physical stock count showed trading stock of 64,000. And then here we are. In the general journal, we have B. Baloyi stores, and the moment goods have been returned, that simply means we are going to debit our creditors control. We are decreasing our creditors control. So we debit creditors control 700, and then we credit our trading stock. In other words, we're decreasing our trading stock because we have returned goods, and here it becomes 700 as well. Very important. When goods are returned to the creditor, we debit our creditors control, we are decreasing our creditors, and then we credit our trading stock. That is, we're also decreasing our trading stock. And then the physical stock taking showed amount of 64,000 that is on the trading stock. So it simply means if we take our stock, which was 63,800 according to the records, then we return some goods, and the goods that we returned is 700. So I'll come in and say minus 700. According to the records, we must be having stock of 63,100. According to the records, it must be 63,100. But we are told now that after taking a physical stock taking, we found stock of 64,000. That means the stock we have on hand from the physical stock taking is 64,000. If we compare it to our records, which is 63.1, you would find that the stock on hand is more. And how much is the difference? You now say 64,000 minus 63,100. And the difference becomes 900. Now, the fact that my trading stock on hand is more, it means it's a trading stock surplus. So I'll therefore come to record my trading stock surplus. I will debit my trading stock account with 900, and I'll credit my trading stock surplus with 900. Remember, trading stock surplus in this case will be treated as income. I'll show you more when we do the income statement. But in this case, we're going to debit our trading stock with 900, and we credit trading stock surplus with 900. Let's quickly move on to the next aspect. We are now going to record in our general ledger. And in the trading stock account, we start off with a balance, 63,800. Remember, this is an asset, so here is a plus and here is a minus. And there are returns. Here is the 700, the returns. And then we'll now say we are told that the physical stock on hand is 64,000. So I'll come here, here's my balance brought down. My balance brought down is 64,000. Here it becomes balance carried down 64,000. Then I'll add my credit side. It is going to be 700 plus 64. It gives me 64.7. I come here, it's 64,700 as well. Therefore, the difference becomes 900, which is my trading stock surplus. And then I would then record in my trading stock surplus account. Therefore, I'm now coming to the credit side of my trading stock surplus. Then I'll say trading stock 900, and I close it off to my profit and loss. Then I also record 900. When I come now to my trading stock surplus account, remember, I close it off to profit and loss, which is 900 over here. Therefore, I'll also come to my profit and loss, and then I'll have my 900. This is how you'd record your trading stock surplus. We will now do the accounting equation. We want to see the effect of trading stock surplus on the accounting equation. In the accounting equation, we have to understand how the trading stock surplus affects the accounts on the accounting equation. So let us see here. The first one that we're going to do is the return of goods to Baloyi. So the first one is we're going to debit our creditors control. Remember, once you debit creditors control, you are decreasing it. So our liabilities in this case will decrease. And the next one is going to be, we're going to credit our trading stock account. And the moment we credit our trading stock account, which is an asset, our asset decreases, then our owner's equity remains 0. And then to record the trading stock surplus, we will debit trading stock account, that is an asset, so it is a plus. And we will credit trading stock surplus, which is income, so my owner's equity becomes plus, and then there is no effect on the liabilities. We will go for an ad break. See you shortly.